Let's put all of these cues together. What does it mean for our markets? We have Anshul Saigal, who's the Head and Executive Vice President, Kotak PMS, who joins in now to discuss this. Anshul, hi. Welcome to the show. Well, it's definitely a tough market on our hands right now. What would you recommend to your clients at this point? Whether they should probably take some profits, hold on, or whether this is a good time to invest?
Morning, Ekta. Thanks for having me. I'll just paraphrase what Buffett and Munger say in times like this. They say that periods of stress in the market lead to stocks going to their rightful owners. What that means is that people who have been speculating in the markets for short-term gains, they lose their nerve at times like this and they sell. And people who have been buyers, keeping in mind the long-term potential of these businesses, not the tickers, but the businesses, they come in and happily accumulate names which are quality names at reasonable prices, and they hold for the long term and make money. So corrections lead to stocks moving to their rightful owners. Given that, and given how India is positioned at this time, which market in the world will give you 15% compounded growth over a 2-year period at the market level, that is, not even at individual stock level? I don't see any market of major significance which would give you that. And as a result, our assessment would be that interest in Indian equities will sustain, albeit this is a speed breaker which is playing out at this moment. So someone who's buying for the businesses and for creating wealth in the long term and not speculating in 1 or 2 or 3 months, I don't see a reason why they should be sellers unless they're holding less quality, bad quality stocks. And so I wouldn't be a votary to sell into a correction. I would be a votary to have patience and hold on.
Patience and hold on, always a virtue in the stock markets. Anshul, just hang in there. We also have Sonia joining in now. Sonia, what a day to be, tracking third consecutive days of falls. The broader markets, almost 10 stocks declining for every stock which is advancing, and this has happened for 3 days in a row.
And it's happened so fast, right? I mean, if you look at the ferocity with which this market has gone from a buy on rally to a buy on dips to a sell on rally, I mean, the texture of this market has really changed, and that is the worrying bit. Anshul, good afternoon. I wanted your thoughts on this, because do you think this is only linked to the geopolitical crisis at the moment and the fear that it might escalate, engulfing more markets with it? Or has the texture of this market changed altogether for the near to medium term? What's your own assessment?
Good afternoon, Sonia. So if you look at, say, the last 20 years, which is really my working life in the markets, I have seen multiple bull markets with 15-20% corrections within the bull phase. And maybe even a larger correction in the small and mid caps within these bull phases. In fact, I recall between 2003 to 7, the markets were up nearly 7 times. And there were 3 to 4 corrections of 15 to 20% within that rally of a 7x index at the index level. Same has played out between 2013 to 2023. Now, what we know for sure is that if markets become expensive, if money making becomes easy, then markets do give you a hiccup. They give you a speed breaker where the weak hands, they kind of sell out, they become nervous, and it is the strong hands who come in and buy. It is one such trend playing out just now. Markets were expensive, particularly the small and mid caps. They were trading at a 20% premium to the large caps, while they trade at generally a discount to large caps. Given that this is a healthy correction, and it is only good for the health of the market, it will create a nice platform for the markets to move 2-3 years out from here. So I think the market remains in a long-term bullish trend. As I mentioned, 15% earnings growth. I don't see any other major market having that. And so markets remain in a bullish trend over the long term. Short-term hiccups are part of the game.
Absolutely, well put out there. I mean, a lot on the street were worried about the divergence between the mid caps and the large caps. Some hope that the large caps will catch up. What's happened is otherwise now the mid caps have fallen. So in any case, so the froth is getting out of the system. Your thoughts, Anshul, on where one should park their capital for safety in times of volatility right now? Would you look at good quality large caps which haven't run, or some mid caps which have fallen and come back to comfortable valuation zones? Just wanted to understand where should one park their money right now?
So if there is new monies coming into the markets, clearly this is a time to be cautious on small and mid caps. It would be advisable to be more in large caps for the reason that relatively large caps have become cheaper versus small and mid caps. In our portfolios also, I must mention, over the last 2-3 months, we have been taking some monies off the table in small and mid caps and parking those monies in large caps for the reason that I just mentioned. And just be in the near term a little cautious on this volatility. But if you find, again, it has to be a stock specific approach. If you find stocks that you've been tracking which have become attractive in valuations, then don't hesitate. Don't worry about what's happening in the markets in general. If you think value is far greater than current price, then definitely slowly build on to those names, even at these levels, these times when markets are volatile.
Okay, Anshul, say we are anticipating a little bit of uncertainty going forward as well. If you had to list out what would be the biggest cue that you would watch out for in terms of assessing whether there would be a fresh leg of correction for the markets, what would it be? 1, geopolitics. 2, its impact on crude prices, or crude prices remaining within this $85-90 range. 3, maybe a harder landing in the US when it comes to the GDP data and other macroeconomics.
Ekta, that's a very valid point, very important point. I think that in the Indian context, we don't have too many things to worry about in the Indian, markets, Indian economy as such, because we are in as many people say, in a Goldilocks sort of a scenario at this time. What we have to worry about is geopolitics, global issues, maybe a slowdown in US, maybe a credit event in US. That's what we have to worry about. But it's very hard to position yourself beforehand for these events. It's only in hindsight that you'll get to know that a credit event has actually played out. And as a result, asset allocation is something that all investors should follow. Have some, breakup of assets into various asset classes, so that if there is volatility, you have cash on the sidelines to come in and invest more into the markets. But like you said, it is really global events which will determine market direction. India is not decoupled from the world as regards the markets. So if there is volatility globally, it will impact India as well. Crude, clearly something to be monitored. And maybe if there is a credit event globally, that is another aspect that one has to clearly monitor.
All right, we will leave it at that. Thanks a lot for joining in. By the way, the market is still under quite a bit of pressure. We are inching towards almost a 1,000-point fall on the sensex. So it's just getting worse by the minute. Not a great day for the bulls at all. In fact, there's no recovery in sight, at least up until now. Let's take a quick break on the